Okay, so good afternoon. I'm part of a class basically on fundamentals of accounting. Here with my group conformed by Camila Rosero, Manuel Moreno, and myself, Herman Gutierrez, will be presenting a small presentation on the conceptual framework for financial reporting. Okay, it's divided into chapters. So initially I'm going to talk about the first 3 chapters on the PDF file that we have, and then my teammates will continue with the presentation. Okay, so on the first chapter we're going to talk about the general purpose of financial reporting. So this chapter basically talks about the objective of financial reporting. The importance of financial reporting is to report information in order to take the best decision possible, so we can aim for the best possible outcome. Okay, so financial reporting is helpful for any user looking to buy, sell, provide, or settle any type of loans, or voting on any influential management action that can be taken by a company. Okay, so in order to make the best possible decision, the user must take a look into cash flows, future prospects, management decisions regarding economic resources of the company. And in order to make the proper assessment, you must take into account resources and how efficiently or not they are being used to generate wealth for the company. So basically, another purpose of the financial reporting is to help assess or keep track of the financial administration and decision taking of the company. Okay, so we have here some elusive images regarding specific keywords like future prospects, how efficient or not a company is, the economic resources that they need to take into account in order to help, or in order to determine the financial reporting objectives. Okay, so the next chapter we're going to talk about is what makes financial information useful. So in this slide we're going to talk about 2 main points and how they're going to help us with the information, the financial information. So the first is relevance and the other is faithful representation. Okay, so information is relevant if it can change the outcome in the decision-making process, so long as it can help predict future scenarios, future businesses, future ventures that the company might have. Faithful representation is very important since it's the ideal way financial information should be presented with all the possible clarity it can. It's not only clear and concise, but it also must be neutral and free from error in order to affect the decision-making process. Okay, the clearer information you have, the more concise information, the more neutral information that you're going to have is going to be a key factor in terms of making the best possible decision. It's going to help you avoid any type of difficulty in the future. So these 2 points basically takes us to 4 key factors. You can see that there are 4 images surrounded by let's say like a little bit of a square. So those 4 images basically represent the 4 key components that we're going to be talking about next, which basically are comparability, verifiability, timeliness, understandability. Okay, so those 4 key components are going to basically take us to the next step. That's basically going to be the benefit constraint. So it's going to be about having the proper information to be able to seize an opportunity with minimum risk or negative consequences, obviously taking into account the main topic here, that's going to be the financial information. Okay, so our next chapter is going to be about the objective and scope of financial statements. So, financial statements basically are a requirement companies have. They don't necessarily have to be done by the same company. They can be done by third parties. It can be an accounting company. It can be an independent accountant. So, the financial report must contain entities' assets, liability, equity, income, and expenses. So you're going to see three types of financial statements. Okay, so you're going to have the consolidated financial statements. It basically is going to give information about assets, liabilities, equity, income, and expenses of both the parents and its subsidiaries. The unconsolidated financial statements are going to give out information about assets, liabilities, equities, income, and expenses of the parent only. And the combined financial statement, that's going to give information basically about a combined two-party financial statement. It's going to be, well, both parties. So that's going to be the end of the first three chapters. From now on, my teammates are gonna take a stab at it. So thank you for your time.